The Federal Reserve is elected to maintain its benchmark federal funds rate at 4.25% to 4.50% for the fifth consecutive meeting, opting for a cautious wait-and-see approach amid rising inflation, uncertainties, and uneven economic signals. In a rare split, Fed Governors Michelle Bowman and Christopher Waller, both appointees of former President Trump, voted against the decision, urging an immediate 25 basis point rate cut. This marks the first time since 1993 that more than one governor dissented on a rate call, signaling growing internal debate over the pace of monetary normalization. GDP growth came in at 3% for Q2, and 104,000 jobs were added in July, underlying resilience in the economy. However, core inflation remains elevated. June's year-over-year rate hovered between 2.7% and 2.9%. Fed Chair Jerome Powell emphasized that current economic strength supports a neutral to mildly restrictive policy stance aimed at maintaining price stability without derailing recovery. He also removed language in the policy statement indicating that uncertainty has diminished, highlighting persistent unknowns, particularly related to tariffs. Donald Trump, invoking strong Q2 GDP data, renewed calls for immediate rate cuts and criticized Powell for resisting. Yet Powell reiterated that presidential influence cannot override the Fed's legally protected independence. J.P. Morgan and other analysts warned that politicizing monetary policy risks destabilizing investor confidence and inflating long-term borrowing costs. Equities. Mixed results. S&P 500 rose slightly, NASDAQ gained modestly, while the Dow fell 0.4%. Bonds. Small dip in yields. The U.S. dollar strengthened, reflecting investor caution. Despite mounting calls from political quarters, most notably former President Trump, the Federal Reserve maintained its cautious posture in July. While economic indicators remain broadly positive, inflation lingers above target, and internal disagreement among officials now appears publicly for the first time in decades. As policymakers reaffirm their independence and focus on incoming data, markets will closely monitor inflation readings, employment trends, and trade dynamics to assess the timing of the Fed's next move.